welcome. I'm Lori Berman, Vice President of Membership and Development with the Small Business Association of Michigan. Thank you for joining us today on this CARES Act package webinar. This webinar is being recorded and will be loaded to the SBAM website later if you'd like to rewatch portions of it or if you'd like to share it with someone else. A special thank you today to Manor Costerisan, they're certified public accountants. They are a great member of our organization, a great partner. We really appreciate the three people that are here today sharing their expertise with us. These webinars are part of a series that SBAM offers regularly to members across the state. So let's get started. I will introduce to you our three panelists for today. From Manor Costerisan, Matthew Latham, CPA, who's the Senior Manager of the Tax Department. Matthew currently holds a position of Senior Manager in the firm's tax department. He specializes in working closely held businesses in minimizing tax liability and maximizing business growth and value. Also joining us is Sarah Jennings, CPA, CFE, CAE. She's Principal in Accounting and Outsourced Solutions, and she's also Director of Strategic Initiatives and Community Involvement. Sarah currently serves as Principal in the firm's Accounting and Outsourced Solutions Department. She leads Manor Costerisan's Fraud Forensics Practice and is Chair of Manor Costerisan's Nonprofit Committee. Also joining us today is Dennis Thies, CPA, CVGA, and Principal Director of Manor Costerisan. He also is Principal Audit Department, Accounting and Outsourced Solutions Department. Dennis helps to specialize in leading teams serving primarily small to medium-sized businesses and leads the firm's Manufacturing and Distribution Solutions Group. Thank you for being here today. Thank you for joining us. And now I will turn it over to Sarah Jennings. She'll give you a quick overview of what we're doing. In terms of question and answers, we will be trying to monitor and answer your questions as we go along. There may be more questions that we can answer while we're on this call. We will get back to you if we're not able to take care of them during this session. So Sarah, I'll let you take it away.
Thank you so much, Lori. We gave just about every difficult name that we could throw at you to kick this off. So Costerisan isn't the most friendly word to say, but we certainly appreciate being here and the opportunity to help all of your members as well. We're going to start off today just talking about, if I can, there we go. The CARES Act, which everybody knows right now is the CARES Act, but it's really the Coronavirus Aid, Relief, and Economic Security Act that was enacted last Friday. So we've been busy trying to get our hands around all of that, as all CPAs, attorneys have been. Much of the information that we'll talk about today, we do want to let you know some of the logistics are still being worked out since they're really trying to get all the stimulus money and the whole package out there. So if there is anything that we don't know as being completely ironed out with all of the logistics, as Lori said, we're certainly happy to get back with you or follow up in any way that we can. So the CARES Act was really broken up into two different sections. Title I, or the first section, is Keeping American Workers Paid and Employed Act. And then Title II is Assistance for American Workers, Families, and Businesses. We're going to kind of go backwards, starting with Title II and then go to Title I. I know that many of you have questions on the current financial situation, the loans, the payroll information, the deferrals that we've got out there. So we want to make sure that we have enough time at the end to understand the tax implications for right now and going forward. So we're going to start with Title II, the Assistance for American Workers and Families. And we're going to start off with Matt going over recovery rebates and some individual incentives. There's quite a host of business provisions within that title or within that piece of the act. And then we'll go over employee retention credit. I know we've gotten a lot of questions on, as well as the employer payroll tax deferral. Then we're going to kind of pause, switch gears, and go to some of the loans and things like that. So Matt, if you want to kick it off with some of the individual incentives.
Thank you, Sarah. Good morning, everybody. This certainly has been an interesting time, one with all the shelter-in-place directives, not only here in Michigan, but across the country, and certainly with the act that got passed last Friday, so that it pretty much has impacted quite a few people. So we'll try to work through this as quickly as we possibly can. The most publicized provision of the CARES Act, at least, is the individual tax rebate that is supposed to be coming out starting in a few weeks. That as an individual, you will receive a $1,200 rebate. If you file a joint return, you can double that to $2,400, and then you get a $500 credit for each child, and basically that files a child tax credit. If your child is claimed as a dependent, they will not receive the rebate themselves. Instead, you'll get the $500 credit for that dependent child. There are AGI limitations. For a single person, you start getting phased out at $75,000, and you get completely phased out at $99,000. And then for a joint filer, basically just double those amounts, $150,000 to $198,000. There is a head of household amount as well, from about $112,000 to $136,000. So basically what they're going to do is they are going to take a look to see if you've already filed in 2019. If you haven't, they will then look at 2018. If by chance you are above those thresholds, you actually still might get the credit for 2020. Our understanding is basically how this is going to work is it's going to be a refundable credit on your 2020 return. Supposedly then you're going to have to answer some questions or report whether or not you actually got the credit or how much you got if you happen to be in the phase out. And then if your AGI changes for 2020, say you're over the amount in 18 and 19, but your AGI is lower in 2020, then in theory you will then get the full credit on your 2020 taxes. So it's going to be pretty interesting to see exactly how quickly they'll get these payments out. They've said they're going to start paying it in the next few weeks. One thing we did notice last night was that the IRS apparently is going to try to set up a informational website that you can report direct deposit information if they don't already have it. That way you don't have to wait for a check to come in the mail. So we'll certainly have to keep an eye out for that and the guidance that the IRS decides to put forward. Next, on the next slide. For retirement funds, they are waiving the 10% early withdrawal penalty for early retirement withdrawals up to $100,000, provided that they are for COVID-19 related distributions. From what we can tell, this is more than just if you've been diagnosed with the virus. It's also if you faced any type of adverse financial consequences because of being quarantined, because of your businesses being closed, or because of a government mandated shutdown. So obviously there will be a lot of people in Michigan that will qualify for this. Basically what this does is that if you would have been otherwise penalized, you'll be able to claim a waiver for the 10% penalty on your 2020 tax return. It also does waive the requirement for RMDs for certain plans and IRAs. So that's something to keep in mind if you actually don't need to take money out. The other most probably publicized provision is that the tax deadlines have been moved back. April 15th is now July 15th. The IRS did it first. Michigan and the governor just did this last week, pushed the April 15th deadline to July. You can still file for an extension in July. At that point, at least for now, you'll need to pay. That extension in July will be an extension to file, not to pay, kind of like the old April extension was. So the other thing to keep in mind is that with estimated payments as well, that the estimate that was due April 15th is now July 15th for the first quarter. Second quarter estimates are still due in June. So your second quarter estimate is now actually going to be the first estimate you need to pay, unless that obviously changes. The other thing to keep in mind, should you have a balance due in 19, and you're actually projecting that you're going to have similar taxable income in 20, you could have an expensive summer with a June payment and then potentially 2 July payments. One potential help could be to file the extension, overpay and cover your first 2 quarters of estimated payments. It still obviously could be a big check, but the hope, and there needs to be some IRS guidance on this, is that the IRS will then apply the overpayment to your first quarter estimate and then your second quarter estimate, which could in theory buy you another month on that second quarter estimate. So again, the IRS might need to help clarify that a little bit. On the next slide. Already again kind of talked about the estimated payments. Also the due date for April, as far as we can tell, it's all April due dates. So C Corps, 1040s, if you have a gift tax returns, trust, estates, that's for everybody. Cities, if you have a city return in Michigan, we're also pushed back by the executive order. Some of the cities have already done it. I know Lansing had done it, East Lansing had done it. I'm sure there were others, but Grand Rapids, I think I saw it done it as well. But the state or the executive order actually pushed back the city deadlines as well to July 31st. So that's something to keep in mind as well if you have to file in a city. Charitable contributions. For 2020, you are permitted to take your first $300 charitable deduction as a 4 AGI or an above the line deduction on your 1040. You do have to be a standard deduction filer to claim this. The logic there obviously being if you itemize, you're going to get your charitable contributions anyways. They've also waived the charitable contribution income limits for 2020. So again, it's a good time that if you have a charity you'd like to support, to give them some money, that the IRS and the government's tried to make it a little more advantageous for you to do it during this time. Next, and really what I hope to spend most of my brief time is on the business portions. There were a lot of simple changes. There were some corrections done to the tax code as well. The first change was with net operating losses. The Tax Cuts and Jobs Act that passed back towards the end of 17 limited NOLs to 80% of your taxable income in future years. So for example, if you had a loss in 2018 and then income in 2019, you would only be able to take up to 80% of your taxable income in 19 with that NOL. The remainder would carry forward. You could also not carry that back. Well, the CARES Act has changed that. For losses in your tax year, 2018, 19, and 20, and I stress tax year because if you have a corporation as a fiscal year filer, they did amend part of the tax code to keep it in line with everything else so that it doesn't look at your fiscal year, it actually looks at your tax year, that there are no limits on these NOL deductions for those years. So now if you have that loss in 18, you can apply it all to 19, regardless of what your taxable income is. And then if some of it carries forward, it goes to 20. You can also elect or decide to carry it back 5 years. So you potentially go back all the way to 2013. That is important to think about, and I'll get into in a second because tax rates obviously have changed between 2017 and 18. And then going forward to 2021, if by chance you have any losses that carry forward all the way to 2021 in the future, then those losses are going to be once again subject to the 80% rule again, specifically for the 18, 19, and 20 losses. So this 100% allowance is a brief allowance to try to get us through this time. If you happen to have any losses prior to 2018 that are still there, the rules for those have remained unchanged. On the next slide, you'll see that for our businesses that have pass-through entities, or if you're a single member LLC, those losses and those rules also apply in your 1040. if there was an additional limitation put in place under the Tax Cuts and Jobs Act that actually limited those losses to $500,000 on a joint return, then what they've done is they've waived that limitation, and it's also allowed you to carry back those losses. The state will need to clarify. Right now under the CIT, they do not allow carrybacks. So that if you're a C Corp and you have a loss, at least as of right now, those CIT losses you'll have to carry forward. 1040s, they're going to need to clarify what you can do. Typically, the state has for 1040s for the losses there for our pass-through entities. They usually conform to the federal rules, but right now they've tried to simplify it by not allowing you to carry back, so that the state probably will need to at least issue some clarification on what you can do. And if you happen to file in other states, make sure that you check those rules as well, because the states, some states automatically conform to the federal tax code, some don't. So you just need to be aware, just don't make assumptions that you're going to be able to carry it back. On the next slide, for the impacts of these carrybacks, just some big picture things to think about. If you have other deductions that potentially could be impacted, other credits, you'll want to kind of take a look and maybe just run a quick analysis on how much money you'll actually get back. If you've had ownership changes over the prior years, especially if you're a pass-through entity, is that something you need to think about? One potential or a couple of potential positives that I see is that the rates were higher before 2018. So for C Corps, you're taking a loss in a 21% tax year and you're moving it to a 35% tax year, more than likely. Individuals, right now you're as high as 37%. Back before 2018, it was 39.6%. Plus, there were people that had AMT issues, or a lot more people that had AMT issues prior to 2018. So in theory, you probably have a lot more tax you can recoup by carrying it back versus carrying it forward. Obviously, losses being fully deductible certainly is a positive. And then right now, you're able to have access to tax dollars you otherwise wouldn't have been able to get. So certainly some advantages there. On the next slide, the corporate AMT, under the Tax Cuts and Jobs Act, the AMT credits were limited on what you could get. Under the CARES Act, they're fully refundable. This ends in 2021, so again, it's for a short term. Business interest expense, this is something that I know our firm deals a lot with, especially in the real estate industry. If you didn't elect out of the interest expense limitations, the interest expense limits have gone up from 30% to 50% of your adjusted taxable income, or what they call adjusted taxable income, for only 2019 and 2020. The other potential positive here is that you can actually elect on your 2020 return to apply whatever your 2019 adjusted taxable income is. Again, going under the theory that everything was booming in 19, and now with, obviously everything kind of coming to slowing down or coming to a halt. In theory, if your income's going to be lower in 20, you could be limited in 20, but if you can apply your 2019 adjusted taxable income amount to 20, then you're going to be able to get a bigger deduction on your business return. And then I'll get in a second, what do you do? Because I'm sure one of the most common questions we've gotten so far is what do you do if you've already filed? But we'll get into that in just a minute. On the next slide, the other, what I feel is biggest change for businesses is under qualified improvement property. Before the Tax Cuts and Jobs Act, if you had a leasehold improvement, a restaurant improvement, a retail improvement, you were able to depreciate it over 15 years. The benefit of this, instead of adding it as a building for 39, the major benefit of this made it bonus eligible. So whether it was 50 or 100%, depending on what bonus depreciation was at the time. Under the Tax Cuts and Jobs Act, they tried to simplify it by lumping all of those groups into one category called qualified improvement property. but they created a glitch because they forgot to change it to 15 years, which meant if you had a qualified improvement, you had to add it and depreciate it as a 39-year property over the life of the building. For the last couple of years, we've been hearing they're going to fix it, they're going to fix it, they're going to fix it. They hadn't yet. The CARES Act provided them the opportunity. They've now gone back and fixed it. They've actually made this retroactive to the start of the Tax Cuts and Jobs Act, which means if you've had a qualified improvement addition that you added at 39 years after September 27th, or it's effective as of September 28th of 17, you can actually go back and now classify as a 15-year asset, which then makes it bonus eligible, so that certainly for 17 and 18, you'd be able to get 100% bonus depreciation. This is an area that we feel the IRS is going to have to provide some guidance on how to fix. One way is to potentially amend your 2017 and 18 returns. Again, you're going to want to look back again at tax rates, look back at, if you have ownership changes, see exactly how far the ripple effect goes. The potential more quote unquote easier way, we believe that you're going to be able to file what's called a change of accounting method in 2019. This is going to create a negative adjustment to your taxable income for 2019, which under the tax code you can take immediately. So that would increase your expenses for 19. Again, you might need to take into consideration things like ownership changes to see if that's really, what you should be doing. Obviously, if there's any type of buyers or sellers agreement out there, just want to look over to see, again, exactly what you're impacting. And finally, on the next slide, on the business side, I've already mentioned a couple of times that the IRS and Treasury does still need to provide some guidance under these new rules on, and hopefully, they'll do it as quickly as they possibly can, since this is impacting returns that are being filed right now. I do want to mention that many returns can take some time to process. They usually don't go on the top of the pile in the Treasury Department, whether that's state or federal. So it could take a little bit of time, a couple of months, few months for them to actually process the return. That's why I mentioned on the prior slide to maybe take a look at filing a 3115, because then it will hit your 2019 return right away. If you have already filed in 2019 and these changes impact you, you can always go back and amend. But what some people don't realize is you can file what's called a superseded return. And basically, to do this, the original due date of your return cannot have passed, so that if you're a pass-through and you filed before March 15th and you didn't extend, then unfortunately, this path isn't going to work for you. You're going to have to go back and amend. But on your personal return, since the due date's been pushed back to July, or if you've extended already, whether that's to September for the pass-through returns or October, and maybe you've filed since you've extended, you can actually file a superseded return, which basically you just redo the return, you refile it. You do have to mark it and note that it's a superseded return, and then the IRS will process it like any other return, and it will take its place of the original return that you filed. Again, though, your due date of your return cannot have passed. So that is one benefit to filing extensions. And I will also mention for the 1040 extensions in July, it'll extend the return to October, or for C Corp extensions in July, it'll extend the return till October. It doesn't give you an extra 6 months like a normal extension would do in April. So keep that in mind as you move forward in the summer. So that is tax update speed round, because I feel like I could spend half a day on these topics alone. So I don't know if there are any questions related to this section.
Thank you. Yeah, Matthew, actually there's quite a few. I'm just trying to look through and see the ones that match up with your topics. We're getting several here. The first one was, what if I already applied for 2019 taxes and I see it right on this slide? Looks like the answer is you can refile.
Yeah, so again, the idea is that if you've already filed and the due date of the return has not passed, you can simply file again a superseded return. If the due date's passed,
Okay.
then and you haven't extended, then you have to file an amended return.
Someone is asking, what about a bonus for equipment?
Assuming that you're talking about, or the person's talking about bonus depreciation for equipment, any type of equipment is eligible for bonus depreciation, which you can take whether or not you have income, whether or not the property is new or used. So it's pretty advantageous to take a look at that to help increase your expenses.
Another question, what about federal payroll tax? Is that deadline delayed?
We got that in just a couple slides.
That's coming up.
Okay, perfect. Yeah, sorry. I know Sarah doesn't have great bandwidth. She said at
So
her
the
house.
answer is yes.
Perfect. This one may be coming up later too. Would the forgiveness loans apply if I only have independent contractors or only employees?
I believe that one is coming up as well.
Okay. All right. Well, let's continue on and we can get to some of these maybe at the end. Thank you for the great information, Matthew.
Thank you.
Perfect. And please let me know, this is Sarah. Thank you for so the next things that we're going to be talking about are the employment credits. There is a refundable tax credit equal to 50% of qualified wages during any calendar year. This applies to the first $10,000 compensation per employee to the employer share of that payroll taxes. And the good news is payroll taxes have been as refundable as a credit back to you. So that's great. One thing I know we've gotten a lot of questions, and this will be kind of a common theme, we have gotten a lot of questions if you're getting some other aid or stimulus throughout this act, can you use both? In this instance, you cannot receive the small business interruption loan either that we watch which credits and funds you're getting. Now we'll look at what some of the qualified wages are. So if an organization has over 100 FTEs on average, the wages paid that are not providing services, so this is only applicable to wages to those employees that aren't working because of COVID-19 circumstances. If it's under 100 employees, it's to all of the wages during the period. And again, the wages are between March 12th and January 1st of 21. And again, I do want to state that the wages taken into account under the Families First Act are not included. This is another area that we just want to make sure that we're not double dipping. Last thing, those employees, all companies, including those with over 500 employees, a lot of questions we've been asking are who's excluded. Other eligibility concerns that we've got are you have to make sure you were in business during 2020 and that you had a decline in business because of COVID-19. Either because you were required by government to shut down, or as we all right now if it's not essential, or you've experienced significant declines in receipts. So this is where we are working through internally on some templates that we're happy to go over with you or provide to SBAM, but really you just have to look in the same quarter of the previous year. Then you have to make sure, because again it says and here, then you have to make sure that your gross receipts are recovering. So you've got that period where your receipts were down because of COVID-19, but we have to make sure that the progress is moving in the right direction. To get things back in operations after hopefully the COVID-19 things calm down a bit. We already had a couple questions on the employer payroll tax deferral. So first, I do want to note this is a deferral. This isn't taking away your liability. So this applies to the employer, Social Security, and self-employment tax. So both self-employment and for organizations. So the employer portion on wages paid in 2020 can be delayed. 50% isn't due until December 31st of 21, and the other 50% isn't due until December 31st of 22. So this doesn't mean, like I said earlier, that you don't have to pay it. You still would record the liability on your books from an accounting perspective. You want to make sure that you're still recording that, and then you can just defer or delay the payment. You cannot receive a CARES Act loan or debt forgiveness and the payroll tax deferral. Again, this is where we're trying to make sure that, not us, but the IRS is trying to make sure that you don't double dip in any of those instances. So next we're going to go over what I think a lot more of the questions are focused on, keeping American workers paid. We're going to go over the payroll, Paycheck, then we're going to go over some of the loan forgiveness considerations, entrepreneurial development grants that are out there. There's some funding for state trade expansion, emergency grants, subsidy, for loan payments, and we will definitely make sure that we have time for questions at the end. As Lori said, you will all be getting these slides. Some of these next ones are a bit detailed. So the Paycheck Protection Program, a lot of people are just referring to PPPL because it is a loan. So it's a loan to companies to keep their workforce employed. And again, as I said in the beginning, most of the Title I or that first section of the CARES Act is related to just keeping people employed. So the calculation includes the compensation to employees and payments to independent contractors. There are some exclusions there. It does not include compensation of employees in excess of $100,000. So this doesn't mean that an employee that makes over $100,000 is excluded completely. It just means that the compensation over that threshold of $100,000 is excluded. Compensation for non-U.S. residents aren't included in this calculation. Qualifications Act are not included. Again, this is kind of that double dipping thing that's going to be So this is just kind of a typical, typical might not be the right word, but an example of how you would go through this calculation. So this calculation, Dennis is going to get into the forgiveness and how that's calculated. This is the total potential loan. So we start off with payroll costs, salaries, wages. This includes commissions, bonuses, things like that. And then we get into cash tips that would be included. You're looking at the last 12 months and taking an average. So you have to calculate what your last 12 months were. PTO is included, again, not that taken because of the Families First. Healthcare benefits, premiums, things like that. Retirement would be included. State and local payroll taxes, and then independent contractors. And again, as I said earlier, the catch on the independent contractors is for a single independent contractor, it can't be over $100,000. So in this example, we're assuming that we've got at least three independent contractors, and they maxed out at $300,000. So then we take our total. So this column, last 12 months, this is the total for the 12 months. We take the total and then we divide that by 12 to get our average monthly payment for payroll costs. So this is, again, 2 million divided by 12. What the Act says is that of your average monthly expense for the last 12 months. So that's where we're multiplying that by 2.5 to get the total potential loan of $595,000. This is the maximum amount of the loan, or 10 million, whichever is lower. So in this example, obviously, we didn't have to consider the $10 million. I know there were some questions, and we certainly can cover that in a minute too.
Yes, we have 60 questions. Oh, I'm just going to say, I'm sorry, we can't get to all the questions, but we will try and address them after this webinar if we're not able to. Keep going, Sarah.
Thank you. And I've been trying to look at them. So hopefully, Dennis and Matt and I were trying to respond as we go through things as well. So related to eligibility for the Paycheck Protection Program, it's employers with 500 or fewer employees, self-employed individuals, sole proprietors, independent contractors can apply for this. 501c3 organizations. The caveat is you have to be in business as of February 15th of 2020. The other thing that you will have to prove is that you're using these funds for payroll costs, group health care, interest on your mortgages that were incurred prior to the coverage period, interest on other debt, again, incurred prior to the covered period, utilities, and rent. And Dennis is going to go through how the loan forgiveness is calculated through that.
All right, thank you, Sarah. Well, the amount of forgiveness or canceled indebtedness, essentially this is an administrative thing that'll work its way out within 90 days of the determination of that amount. So you'll work that out with your lender. The forgiveness itself includes the payroll costs, interest on covered mortgages, as Sarah had just indicated, rent. And those are, I believe, or they are as of February 15th, if that obligation for both rent and the mortgages existed as of February 15th of 2020, those are eligible. And then also utilities. Next slide, Sarah, please. Okay, so here's where the rubber hits the road on the loan forgiveness. We start on the top with the initial loan amount that a few slides ago Sarah went through that process, the $595,000. Then the next several lines, starting with payroll costs, is a separate calculation. And so we talked about the payroll costs in a previous slide and what is eligible there. And then we have some earnings from self-employment, and our applicable rent, which is again an obligation that existed, a lease agreement that existed before 2/15 of 20. We have utilities. They have a qualifier on that as well, but essentially. The utilities that you incur on facilities that you were using as of 2/15 of 20 qualify. And then interest on other covered mortgages. I believe that there will be more guidance here, as related to interest on other debt as opposed to mortgages. But those amounts are combined here. And so we add all that up. And that's our total potential amount or tentative amount to potentially be forgiven. Then we have to go through a calculation to determine what percentage of that amount will be actually forgiven. And so a very important piece here is the FTEs during that 8-week period. And it's called the covered period, and it's that's what as shown here is the 50 FTEs for that 8-week period on average, and then you divide that number by the amount of the lesser of, and you pick the borrower's choice here. A borrower can make an election here for the next two lines there, the monthly FTE from February 15th of 2019 through June 30th of 2019. You can see that was 59 there. And the monthly average for a much more recent period, if that's more advantageous, which is January 1 or beginning of 2020 through the end of February of 2020. In this situation, that number is lower. And as a result, that 55, although still more than the 50, would result in a higher percentage of the loan being forgiven. Only just over 9% of the loan itself would not be forgiven. And so that calculates up to that 44.6 there. It would be about 15% of the loan if you elected to use the 59,000. So in this situation, you would normally elect to use the higher loan forgiveness. And so of that, roughly 9% of that $490,000 would not be forgiven. There are other, the next consideration is compensation reduction. So essentially, if you have individual employees' compensation that is reduced by in excess of 25%, in compared to the most recent quarter for payroll, which essentially is March 31st. If you have individual employees that their wages decreased more than 25%, then you're going to have to subtract that here. And so it essentially keeps you from playing the game of oh, I'm just going to have more FTEs, or at least as many FTEs, and pay them less. So essentially this is the guard against that. But for each individual employee that would be less than 25% of that most recent quarter, you would need to add all of those up and then subtract them from the 490, similar to the way that you did the $44,000. So that leaves you with a balance of the loan not forgiven of about 174.5. Okay, so as I said before, relatively quickly those amounts will be forgiven, and that'll work through with your lender. But this remaining 174,000, if you can advance the slide, Sarah, then that will be it has an interest rate not to exceed 4%. The portion that's not forgiven shall have a maturity maximum date of 10 years. It can be shorter. And then you can also work again with your lender to get either a 6-month or a 1 year, not more than 1 year actual deferral before you have to start paying principal and interest. So an added benefit there from a cash flow perspective. Next slide, thank you. There is a small provision in here for those of you that are dealing with the economic injury disaster loans through the SBA, which are substantially covered under different legislation. This allows you to get a $10,000 advance on those dollars, because it's anticipated that those monies will take more time to be able to advance. There are and as the slide says, they anticipate providing those funds within 3 days, and that in essence, once things get up and rolling here, I think that the banks are basically saying, give us a week to get prepared with how we're going to work with the SBA on this, and then let's start the process. So there's a lot that has to occur on their end, and as a result, you probably won't be able to call this afternoon and execute this. But I would encourage you to, if you haven't already, to reach out to your lender, and hopefully they are an SBA loan provider qualified to do this, and they will be able to provide additional assistance in working through the process. There are a few other provisions in here. There are significant dollars, $265 million, going through the small business development centers and women business centers for additional resources to provide education, training, and other advisory services. Those, I believe, are just getting off the ground. So, it may take a little while for those to ramp up, but that's significant funding for those organizations to provide additional assistance as well. small business debt relief. There's about $17 billion in funding that is applied to that specific provision. Requires the SBA to pay all the principal and interest on the fees on covered SBA loan products, and those are 7As and 504s. Again, I highly recommend that you begin. This is one of the first things you can begin working with your banker on, especially if they did your SBA loan, to be able to work through that process, because being able to defer your principal and interest portions on your long-term debt can be an incredible savings in overall quick cash flow in the short term. Those items those exist before the CARES Act, and those made in the following 6 months. So that's where those that's the loans that those actually apply to, and the period of deferral would be for 6 months. I know that there are probably questions that relate back to not only what I just talked about, but also what Sarah and possibly Matt was. Lori, I'll kick it back over to you if you want to go through those.
Great, thank you. I appreciate all the good information that you've had here. There are 130 questions and we are not able to get through to them all. I would encourage you, if we don't answer your question today, to send them to sbam@sbam.org. So that's sbam@sbam.org, so we can get through and assist you with all of your answers. So I will take a few of these questions here and pass them on to you to see what you could say. First one, can you provide detail for calculating FTEs? We are a seasonal business and we use a lot of part-time students.
Yeah, I believe that that will fall in line with the normal process for calculating FTEs, and that will result in the hours that they're working in relation to a 40-hour work week.
Thank you. And a couple of people asked what an FTE is, and is a full-time employee. It's just an acronym for a full-time employee. Go ahead.
Yes. Yeah.
All right, here's another one. My wife and I run a business with no employees. We do not have a brick and mortar retail store. We switched from sole proprietor to LLC in 2019. We added her as a co-owner at that time. Do we qualify for the CARES Act?
The was established before February 15th of 2020. So I believe that business
yes.
Yep. Yep. Yes.
And I've had two questions. If you're in the hemp industry or the marijuana industry, does the CARE Act apply?
We can follow up on that, but
Okay.
my initial impression is that it does not, because for federal purposes, the marijuana industry is not considered a legal industry.
Okay. I've had two questions related to figuring payroll. First one is, how do you calculate commissions? Do you do that on an average?
The commissions would be over the last 12 months, so anything that was paid, because you're taking the actual over the last 12 months and then averaging that out.
Okay, so it would be actuals from the last 12 months. And then also to add to that, are bonuses included in that line item of payroll commissions? Are bonuses part of that as well?
If paid over the last 12 months, yep.
Yep, okay. All right. Next one, are churches eligible and nonprofits like libraries and schools, are they eligible for the CARES Act?
There is definitely, this is Sarah, there is definitely some pieces that they are, and 501c3s, the charitables, have a lot of leeway to take advantage of the loans as well as some of the other payroll areas. It's really the trade associations that didn't get all of the provisions.
Okay. I'm looking through. Can LLC dividends to owners count towards the payroll amount? That's same subject. Be dividends.
Matt, you want to take that one?
I believe that LLC distributions or dividends, provided that it's from an S corp and or a partnership and there aren't any basis concerns, would not count.
Okay. And currently my business is closed because of the EO stay in place and my employees are laid off. Do I pay my employees and they come off unemployment if I get a payroll protection loan? Or do I just hire them back when we are allowed to go back to work? I think we're getting this one a lot.
Yeah, if they're on unemployment, they can't fall under the Families First and get additional unemployment. And then also you get the loan for the payroll protection. So you just have to make sure that that's segregated. If you went ahead and hired them back, you can start calculating that loan forgiveness from the actual payments that you're paying them.
Okay, so can't double dip. They can't get
Right.
unemployment and you can't get the CARES payroll protection.
And
So here's
just to add to that, Lori, if I could just add that just be careful that you are adding or starting at the beginning of the loan. The origination is when that covered period starts. So that's what physically counts there.
Okay. Someone else has another question. I think we just answered this. You mentioned wages for the average for the PPP. What do I have read said there's a period of time, February to June 2019. And Sarah, you just said that. Would you say it again?
Say that one more time.
Yes, please. Oh, would like a verification on PPP. You mentioned a year of wages for the average, but what I have read, there is a period of time, February to June 2019.
Yes, there are some alternatives that are out there. If in certain situations, and that I believe relates to the seasonal employees.
Yep.
And I think specifically that is when we're talking about the loan forgiveness, that can be the amount in the denominator there,
Okay.
There is also some that's right, Dennis, for seasonal employees. If your season starts earlier, they wanted to make sure that that is still prorated and through the season. So you can use that instead of the calendar year. Yep.
Okay. Next one, if I lay off all of my employees tomorrow, can I file for the PPP loan and be in compliance for forgiveness? Like we just talked about that.
I don't believe, essentially, by laying off all of your employees, your compensation costs, and more importantly, your FTEs would drop dramatically.
Mm-hmm.
As a result, the percentage of your loan that would be forgiven would also drop dramatically. So it would significantly impact the amount of forgiveness that you would be able to calculate.
Thank you. And a few other questions here. Just a reminder that this CARES
Right. It's really important to remember that you can get the.
Go ahead.
I'm so sorry, Lori. It was just a reminder to make sure people understand that you can get the loan based on these calculations, but you have to use the funding for the allowable things like the payroll, the rent, the utilities that Dennis went over, or it's not going to be forgiven at all. So we just want to make sure that you don't just get the money and then lay off your people, because then it won't be forgiven at all, like Dennis said.
Right. This is a new question. Will the loan forgiveness be added to profits for the business for 2020 tax filings? Do we know that?
It is supposed to be exempt from income tax.
Okay. Next one, if I apply for the economic injury disaster loan 10,000 advance, am I disqualified for the PPP SBA forgiveness loan?
I believe the way that $10,000 advance would work is you would have had to have applied for the economic injury disaster loan, and then that would be an advance, on that.
Okay.
The tweak there is that if you don't end up getting the EIE or EID loan, then that amount can be forgiven.
Okay, thank you. And also on that question, I was on a call with the SBA earlier this morning, and they had not issued a determination on that. So watch for more information to come regarding that $10,000 loan forgiveness, and if it disqualifies you from anything else. It sounds like we were waiting for a determination on that as well. Other questions? Just looking through. Is proof of hardship let's say this again, is the proof of hardship lower receivables applied to the Paycheck Protection Program or one of the other programs?
The Paycheck Protection Program, it essentially does not, there is a certification that you need to actually give at the beginning and the end. One, basically a statement at the beginning is basically a statement that says that you are being harmed by the COVID-19 dynamics that are going on. And then at the end, there is also a certification that, I think that's more in line with the costs are true and direct. So I think that first certification there is important. That's something that the applicant needs to be able to provide.
Great, thank you. And then one last question. You said that trades are not getting full benefit from the CARES Act. Can you explain?
There are some exclusions and some things that we are actually sifting through to make sure that we have full clarity on which 501c organizations of the tax exempt organizations have. Most of the 501c3, which are charitable organizations, our funding opportunities are not, it doesn't appear that they're available for the 501c6. So it's just a different tax exempt status.
Great, thank you. Again, we are not able to get through all of the questions and answers. If you'd like to send them to sbam@sbam.org, we'll be happy to answer those. I want to say again, thank you so much for Matthew, Dennis, and Sarah pulling this together. We really appreciate Maynard Costerisan as a partner. I wanted to remind those that are on the webinar today that we do have other webinars coming up this week to try and help you out. We have one tomorrow, which is April 1st at noon. It's understanding the FFCRA, and if your small business is critical infrastructure, and if your workers should during the Stay at Home, Stay Safe Act. So that one, you can find information on our website to register for that. That is tomorrow, April 1st at noon. We have another one on Thursday at noon, which is HR and legal strategies of the CARES Act. And then on Friday at 10 o'clock, many of your questions coming in here are related to navigating financial options during this COVID crisis. The SBDC is doing that one with us on Thursday. So there will be more information coming out regarding loans. Again, thank you so much. We appreciate you being here, and we hope that you'll join us for another webinar this week. Thank you again. Take care.